Welcome to Integrated Insights with ICCG. For more than 30 years, our team has partnered with small business owners to prepare for and navigate the business transaction process. Pull up a chair as we share stories and insights from our experience on all sides of the M&A table. And welcome back to another episode of Integrated Insights. My name is Michael Hefner. I'll be your host again today. I'm joined by one of the founders of ICCG, Grant McQuilkin. Grant, thanks for joining me.
Howdy.
Today, we're going to be talking about Q of E's, or quality of earnings. These are done by banks. We're going to talk about what they are and when they happen. So, Grant, just to get started, tell everybody, what is a Q of E?
Yeah, that's a great question. It's generally a deep dive into the financials, metrics, working capital, accounting methods, revenue model of a business, and it's generally done by a CPA firm that is typically in the business of doing attest functions. And so I think buyers a lot of times will order a quality of earnings, and the reason for it is it varies. So what I'm supposed to say is that the reason why you order it is because it's a really deep dive look under the hood to make sure that the buyer is not surprised by anything. It's not an audit. An audit is very different. An audit is an opinion that the financial statements accurately reflect the financial position of the company. A quality of earnings is more of a deep dive into what those numbers are, how the revenue model is reflected in the accounting methods, those kinds of things, metrics, sales by customer metrics, maybe concentrations, those kinds of things. And I think if I'm wanting to be nice, they're extremely helpful to a buyer. In the long time past, we did a lot of that work as part of due diligence. And so this is not a replacement for due diligence, but nowadays it's a big part of due diligence for PE groups. But a lot of times it's just to cover the butt of PE groups who have limited partners, so that they can use a big name accounting firm with a lot of expertise and a big insurance policy to protect them from making mistakes.
Yeah. And is there a little bit too of like just giving additional insights, or is it, like you said, is it just the mistakes part?
Yeah, I've seen both. I mean, and I've been impressed with some firms who really, really help buyers look at what matters in the whole part, in the accounting, or what metrics are important to the buyer. And then I've seen some that are just mechanical, just clinical, fill in the spreadsheet and hand it over. And you've got to sit there and interpret it yourself, basically. And so, they're helpful. I think they're somewhat of an insurance policy most of the time, but it's more and more regular for a P group, for example, a buyer to order a quality of earnings. It's actually now done by some sellers before that happens. And so a seller will order one to get ready for the process. Yeah, I mean, they just want to avoid surprises, want to make sure that they're not going to get hammered once some big name accounting firm comes in and does it. We've got a client right now that's doing that. I think it's more typical though if small, medium-sized business doesn't get audits, and they're not 100% confident that their accounting method is generally accepted accounting principles or that reflects the timing and extent of revenue and expenses appropriately, then they want to have a heads up and make sure that they're not getting into something that they're going to get drilled come due diligence.
Yeah. So is there ever a deal that requires to have a Q of E, or is it just a matter of preference and how helpful it will be?
Yeah, I mean, look, the only people that can ever require a Q of E are banks or investors. Right. And so that's why I said PE groups, sometimes it's part of the investment, sort of metric. And then, here recently, when we were representing a buyer, the bank, his financing source required him to do a Q of E. And so, I think that's where we've helped buyers, with maybe what is more an affordable option or a more affordable option is just to limit the scope of a Q of E. If you go into a CPA firm and say, I need a quality of earnings, then they're going to do their full-blown process. Think car wash, right? You go in there and you want a detail, right? And that's the only product that they have, then you're going to pay a lot. But if you go in the car wash and the only thing you really want is you just drove through some mud and you want your tires cleaned, right? And so you can limit the car wash to just getting your tires cleaned, and then you don't pay as much as them thinking, oh, I've got to detail the inside of the car. And so my point is that a limited scope Q of E or quality of earnings can really zone in on the metrics that buyers need to know, because those are the metrics that drive the success of the business. And so an example might be in a medical business again, they need to know patient count trends. They need to know payers. Who are the insurance companies that generally serve that area and what their rates are, and what is it in network, out of network, all those kinds of things. And they could give a rip what the CPA firm thinks about payroll. Right.
So you talked about CPAs are usually the ones doing quality of earnings. Can any CPA firm do a quality of earning? Is it the same value one to the next? I know you talked about scope, but can you go for a similar scope from one CPA firm to the next and get a similar value out, or what does that look like?
I mean, quality of earnings is an attest function, and so you have to understand CPA firms are also they go through a review every year. And that review, or not every year for all of them, but that review is light or intense, depending on the type of work that they do. And so if you're a CPA firm that does some light accounting and then does tax returns, you're not going to be able to do a quality of earnings, or you're not going to be able to do an audit. But because those firms, they go through a pretty intense review to make sure that they're doing the processes necessary to make those opinions worth anything. And so generally, I would say it's your larger CPA firms that'll do a quality of earnings. And honestly, if you're paying that much money to get a quality of earnings, you want a name behind it that's recognizable or at least reputable, so that you are covering your butt, like I said, and you're not just having somebody who is going in there and kind of going through the motions.
Yeah. That's great. So in a previous episode, we've talked about the difference between different intermediaries and how we kind of measure up to that. What you were just talking about making sure someone's reputable in that industry and stuff like that. When somebody comes to us and they need a Q of E, what do we tell them? We just say, okay, go do it then. We will only refer them to larger firms that are
that'll lend themselves to, that have the reputation, but it's not just about reputation. Again, like I said earlier, there's some utility to it. They are good at what they do, and you want them to have that expertise to help you. At the same time, that's a buyer that comes to us, right? And they want a Q of E. If a seller comes to us and they say they want a Q of E, we know enough about accounting to know, let's limit the scope, or let's make sure that they absolutely need it. And it might be better for them to get, to hire a sort of a 3-month stint of a really sharp CPA, part-time, to go clean up their financial statements. And that might be worth more than getting a quality of earnings, right? And so, it's not just, we just don't send them down the road to go get one. We really want to know why they're going to get one and what's the purpose. And we don't necessarily automatically tell people they need to get one. We really wait until we see what the utility of it is.
Yeah. And what I would just add there is, we are always meeting with CPAs. We're always meeting with banks. We are always meeting with business professionals to make sure that we know how to steer our clients in the right direction and to help them. So anyone that comes to us is never just out on their own, never just, okay, go get that done. But we can usually help steer them in the right direction. So last question I got for you, Grant. How can the results of a Q of E affect a deal? So you said that there's some KPI analysis in there and some things like that. How have you seen the results of a Q of E affect a deal?
Yeah, the easiest obvious answer is, that the buyer sees something they don't like and they retrade, right? They don't want to pay as much. We see sometimes they notice something and they change their focus of their due diligence. They add something that's really important to them. If they find out, for example, one of our clients 1 year during a Q of E, they didn't like the fact that we said there wasn't any concentration of sales, because a ton of their customers were actually commonly owned by a parent company, even though they ordered and dealt with our clients separately. They combined them and they wanted to look at that concentration of sales, for example, in their due diligence. So it didn't change they didn't come and retrade. They just wanted another look at that. There's a lot of people who use the quality of earnings to actually assess what the right working capital peg is. And so that sometimes changes the deals. And then just, the confidence that lenders and investors have in making the purchase happen. Sometimes it boosts that confidence for sure.
Yeah. So it's a little bit of doubling down on that, Dave Parker saying of bad news doesn't get better with age, right?
Yeah, you bet. And
the more you can get in front of that and let there be no new information, the better. So
that's right.
Awesome. Good stuff. Well, Grant, anything to add before we wrap up this episode?
No, appreciate your time.
Yeah, awesome. Well, thanks for joining me again, and everyone, we'll see you again on the next episode. And that wraps up another episode of Integrated Insights with ICCG. Be sure to subscribe and stay tuned for more stories from our team. We love hearing from our listeners. If you have any questions or topics you'd like us to cover, please send us an email in the show notes. For more information about ICCG, please check us out on our website or follow us on LinkedIn and YouTube. Until next time, there's always a seat at our table.